Gibson Energy has transitioned into a North American liquids infrastructure entity. For investors, Gibson represents an intersection of high-yield income and infrastructure growth, anchored by strategic assets in the Western Canadian Sedimentary Basin and the United States Gulf Coast. The fundamental investment thesis for Gibson Energy is currently defined by the Texas Pivot, a strategic shift initiated in 2023 to expand its footprint into the global export market via the South Texas Gateway Terminal. This move was not merely a geographic expansion, but a structural de-risking of the company's cash flow profile, intended to increase the proportion of stable, fee-based infrastructure earnings while reducing the cyclical volatility associated with its traditional marketing business. The history of Gibson Energy spans over 70 years, beginning in 1953 as a regional energy logistics provider in Alberta. For decades, the company's identity was tied to the physical handling and marketing of crude oil, utilizing a network of trucks and small terminals to connect producers to major pipeline systems. However, the last decade has seen a deliberate transformation of the business model. Gibson has divested its non-core high-volatility assets, including its environmental services and industrial propane businesses, to focus exclusively on liquids infrastructure.
Gibson's Canadian operations are characterized by dominant market positions at the most critical oil hubs in Western Canada, Hardisty and Edmonton. These assets serve as the toll booths of the WCBSB, capturing fees for the storage, blending, and terminaling of crude oil as it moves toward end markets. The Hardisty terminal is arguably Gibson's most valuable Canadian asset. It is the primary pricing and aggregation point for Canadian heavy crude and the origination point for major export pipelines, including the Enbridge Mainline, TC Energy's Keystone, and the Express Platte system. Gibson controls approximately 14 million barrels of storage capacity at Hardisty, representing a significant portion of the hub's independent storage. The operational complexity of Hardisty is enhanced by the presence of 43 tanks across 4 terminals, offering customers flexibility for blending and quality management. This flexibility is essential for producers who need to meet the stringent specifications of downstream refiners in the U.S. Midwest and Gulf Coast. Furthermore, the Hardisty terminal's exclusive access to the Hardisty Unit Rail Facility, a joint venture with USD Group, provides a critical egress alternative when pipeline capacity is constrained. This facility can load up to 3 unit trains per day, moving approximately 210,000 barrels per day.
A key technological and strategic advantage at Hardisty is the diluent recovery unit. Bitumen produced in the oil sands is too thick to flow through pipelines on its own and must be mixed with diluent, usually light condensate. The DRU allows Gibson to extract that diluent from the bitumen before it is loaded onto railcars, creating a DRU bit product that is non-hazardous and significantly more efficient to ship. This process not only reduces transportation costs for producers, but also preserves pipeline capacity for other products. The Edmonton terminal is strategically positioned in Pipeline Alley, the primary transportation hub for oil produced in northern Alberta. With approximately 1.7 million barrels of existing storage and land capacity for an additional 1.7 million barrels, Edmonton serves as a vital aggregation point for both crude and refined products. In recent years, Gibson has diversified the Edmonton facility to include renewable energy infrastructure. The 2022 completion of the biofuels blending project allowed the terminal to facilitate the storage and blending of renewable diesel, aligning the company with the low-carbon fuel mandates of the Canadian government. Connectivity is the terminal's hallmark, with links to 2 major refineries and the origination point of 2 major egress pipelines, including the newly expanded TMX.
In late 2025, Gibson announced major contract extensions at Edmonton that solidified its long-term cash flow profile. These include a 20-year take-or-pay refined product services agreement and a 10-year terminal storage extension for 800,000 barrels, both with senior integrated oil sands customers. These long-dated commitments underscore the essential nature of Gibson's Edmonton footprint in the global energy value chain. The acquisition of the South Texas Gateway Terminal, STGT, in 2023 represents the Texas pivot that has redefined Gibson's growth trajectory. This asset has provided the company with direct exposure to the world's most prolific shale basin, the Permian, and the rapidly growing seaborne export market. The STGT is a deep-water facility located in Ingleside at the Port of Corpus Christi, providing direct basin access. Its asset specifications and competitive advantages include
Storage capacity, 8.6 million barrels across 20 tanks, allowing for high-capacity aggregation of large export batches. Loading capacity, approximately 800,000 to 1 million BPD. High-speed loading minimizes vessel turnaround time. Dock capacity, 2 VLCC-capable deep-water berths. It is one of only 2 Texas facilities with dual VLCC loading capability. Connectivity, linked to 4 major Permian and Eagle Ford pipelines, including direct access to Cactus II and Gray Oak. The operational performance of STGT has been robust since its integration. By Q3 2025, the terminal reached a record throughput of 717,000 BPD, a 30% increase from its throughput at the time of acquisition. This performance was bolstered by a late 2025 dredging project that increased the depth of the Corpus Christi ship channel at the terminal's docks, allowing Suezmax vessels to carry 10% more volume directly from the berth.
To further capitalize on the Permian Basin's growth, Gibson sanctioned the Wink to Gateway Integration Project in late 2025. This $50 million capital project involves adding new tankage at the Wink Hub and a new pipeline connection at Gateway to debottleneck flows from the Permian and Eagle Ford basins. By providing concurrent flow capabilities for different crude grades, Gibson expects to increase access to supply for its international customers and drive further throughput growth in 2026 and beyond. Gibson Energy's financial strategy is underpinned by a utility-like model for its infrastructure segment, characterized by high-quality take-or-pay contracts that provide predictable cash flow even in volatile commodity environments. However, the company is currently navigating the financial aftermath of the STGT acquisition, which necessitated a temporary increase in leverage. For the full year 2024, Gibson reported record results, driven by the first full year of contribution from STGT. Total revenue reached $11,780 million, and infrastructure-adjusted EBITDA grew by 22% to $601 million. However, net income for the year decreased by 29% to $152 million, primarily due to higher finance costs and one-time executive transition and restructuring charges.
Financial performance trends across 2023-2025 include: infrastructure EBITDA rose from $494 million in FY 2023 to $601 million in FY 2024, maintaining roughly $154 to $155 million quarterly through 2025. Marketing EBITDA dropped significantly from $145 million in FY 2023 to $63 million in FY 2024, reaching near zero in Q1 2025 before a slight recovery to $7 million in Q3 2025. Consolidated EBITDA increased slightly from $590 million in FY 2023 to $610 million in FY 2024, remaining stable at $147 million in the first and third quarters of 2025. Distributable cash flow decreased from $386 million in FY 2023 to $375 million in FY 2024, with Q3 2025 reporting $86 million. Consolidated payout ratio increased from 71% in FY 2024 to 77% in Q1 2025 and 83% in Q3 2025.
The Q3 2025 results highlighted a diverging performance between segments. While infrastructure volumes reached a substantial 211 million barrels, a 26% year-over-year increase, the marketing segment continued to struggle. Marketing EBITDA fell to just $7 million in the quarter, as market backwardation and narrow crude differentials eroded blending margins in Western Canada. This weak marketing performance led to a slight miss in earnings per share, 28 cents actual versus 30 cents forecasted, causing the stock to pull back following the announcement. The acquisition of STGT was funded through a combination of approximately CAD $350 million in subscription receipts, and the balance through unsecured notes and new hybrids. This led to a net debt to adjusted EBITDA ratio of 4.0x by mid-2025, which is at the upper end of what the company and credit rating agencies consider comfortable for a BBB-rated entity. As of Q3 2025, the company's solvency metrics included a net debt to adjusted EBITDA of 4.0x, above the 3.0x to 3.5x target, an infrastructure-only leverage of 4.1x, above the less than 4x target, and an interest coverage, EBIT, of 2.5x. The total debt-to-equity ratio reached 308.3%. Management has expressed high confidence in a long-term deleveraging plan to return the debt-to-EBITDA ratio to the target range of 3.0x to 3.5x by the first half of 2026. This deleveraging will be achieved through growing infrastructure cash flows, disciplined capital expenditure, and a cost reduction program targeting over $25 million in run rate savings by year-end 2025. Gibson has already made progress by refinancing $350 million of 5.80% notes with 4.45% notes, securing annual savings of $5 million. Gibson Energy is currently ranked as one of the highest-yielding stocks in the S&P/TSX Composite Index. The company has a track record of 6 consecutive years of dividend increases, with the annual payout rising from $1.64 in 2024 to $1.72 in 2025. The sustainability of the dividend is supported by the take-or-pay nature of the infrastructure cash flows, which cover approximately 80% of the dividend on an infrastructure-only basis. To manage liquidity and offer flexibility to shareholders, Gibson maintains a shareholder dividend program, which allows investors to receive their quarterly dividends in common shares at a 3% discount to the market price.
The Canadian midstream landscape underwent a structural shift in May 2024 with the startup of the Trans Mountain Expansion (TMX) pipeline. This project nearly tripled the capacity of the Trans Mountain system to a total of 890,000 BPD. The immediate effect of TMX was the easing of pipeline constraints, leading to a narrowing of the Western Canadian Select (WCS) to West Texas Intermediate (WTI) price differential, which dropped from an average of US $18.70 per barrel in late 2023 to approximately US $12 per barrel throughout late 2024 and 2025. For Gibson, this has been a double-edged sword. Record throughput at its terminals has been offset by reduced volatility and arbitrage opportunities in its marketing segment. Despite the current surplus of egress capacity, industry analysts expect the market to tighten again by late 2026 or 2027. 2024 to 2025, excess capacity. Following the TMX startup, marketing margins remain lower while terminal fees stay stable. Late 2026, approaching limits. As production grows, demand for storage and blending is expected to increase. 2027 and beyond, persistent constraints. Pipeline capacity is forecast to be constrained again, potentially leading to renewed volatility, higher marketing margins, and increased rail upside. Enbridge's Mainline Optimization Phase 1, which adds 150,000 BPD of capacity by 2027, is the nearest major relief on the horizon after TMX. As pipelines fill up, Gibson's swing assets, such as its Hardisty storage tanks and rail loading facilities, are expected to regain their premium value.
Gibson's hub-centric, tank-heavy model achieves higher capital efficiency and shorter construction cycles compared to massive pipeline projects. From a valuation standpoint, Gibson Energy currently trades at a premium PE ratio, but remains competitive on an EV to EBITDA basis. Gibson Energy, dividend yield of 6.4% to 6.6%, EV to EBITDA TTM of 13.9x to 14.3x, PE ratio TTM of 28.1x to 29.6x, forward PE of 20.5x. Enbridge, dividend yield of 5.7% to 5.9%, EV to EBITDA TTM of 14.8x to 14.9x, PE ratio TTM of 25.6x to 25.9x, forward PE of 21.6x. Pembina Pipeline, dividend yield of 5.2% to 5.3%, EV to EBITDA TTM of 19.1x to 19.3x, PE ratio TTM of 19.3x. Keyera, dividend yield of 4.8%, EV to EBITDA TTM of 23.7x to 23.9x, PE ratio TTM of 23.9x. The elevated TTM PE ratio for Gibson reflects current earnings pressure from the marketing segment and high depreciation from new assets. However, the forward EV to EBITDA multiple of 10.7x for late 2026 suggests more attractive valuation relative to peers as projects reach full utilization and debt is reduced.
Risk assessment. Financial leverage. With a 4.0x debt-to-EBITDA ratio and a high debt-to-equity ratio of 308%, Gibson is vulnerable to cash flow downturns or interest rate hikes. Marketing volatility. Marketing segment contribution fell dramatically in 2024 and 2025. If differentials remain tight due to excess pipeline capacity, consolidated earnings will remain under pressure. Operational incidents.
Gibson is exposed to risks of leaks, fires, or shipping accidents, which could lead to massive cleanup costs and regulatory fines. Macroeconomic trends: a global recession reducing oil demand, or policy shifts capping oil sands production would threaten throughput at Gibson's terminals. The bear case centers on structural market changes and dividend pressure. Impaired marketing margins. If differentials stay narrow, $10 to $12, the high marketing profits seen in the past may not return, making Gibson a lower growth utility. Slowing Permian growth. If U.S. crude exports peak early or competition for market share at Corpus Christi intensifies, Gibson may struggle to grow gateway throughput. Payout ratio risk. With a consolidated payout ratio at 83%, there is little margin for error. Persistent marketing weakness could force a choice between the dividend and the company's investment-grade rating.
The bull case focuses on the maturation of the Texas pivot and return of egress scarcity. Upside at Gateway. Optimization efforts and potential development of a third dock could push throughput toward 1 million BPD, driving substantial DCF per share accretion. Egress scarcity. If WCSB production growth fills TMX by 2027, demand for Gibson's storage and blending services will increase, potentially reviving high marketing spreads. Multiple expansion. As leverage is reduced to the 3.0 to 3.5x target, the risk premium should compress, potentially re-rating the stock toward peer group multiples. Conclusion. Gibson Energy is a company at a strategic crossroads. Its transformation into a North American infrastructure leader is nearly complete. However, the next 12 to 18 months will be a proving period for management, focused on deleveraging, stabilizing marketing EBITDA, and executing the Wink to Gateway project.